Welcome back. Lesson 5, market cycles. We're going to cover the market cycles in relation to day trading or trading a financial product. Since you understand that companies issue shares of stocks to investors, you also need to understand that there are times where companies create sudden news that causes the personal belief of investors to change, either to buy or sell a specific stock. You can call it manipulation, and since the traders are speculators, they make their own internal beliefs and changes that lead to market prices changing. Let me give you an example. Imagine a company that wants to expand their businesses in larger geographical areas and they need a massive amount of capital to do so. And the company believes that if they do expand, they're able to get more profits down the line. So the company will have to either get a loan from some financial institution or raise the money by issuing more shares. If a company issues more shares, then clearly the pool of shares in the market will increase. And that means the supply increases. That does not necessarily mean that the buyers will also increase. And if we think of supply and demand, when the supply is higher and the buyers are less, the price drops. So a company is cognizant that this may take place, and they cannot announce it until a specific time, and when the moment they do, it will cause a drop of the shares. So now the price of the shares will go low. 3 or 4 months from now, the company, they do their expansion, the profits in fact do increase, and traders, the investors, the speculators, they see the new cycle as more profits. And a lot of investors will come into the financial marketplace. They want to get a piece of the company because they're greedy. And when you have a lot of buyers, but the people that are holding the stock already, they don't want to sell because they also think it's going to increase, then those buyers are going to start bringing the price back up. You have to understand that since every human that is an investor, they have their own personal problems and beliefs and internal thinking as to why they want to buy or sell a specific product. There will always be a seller. There'll always be a buyer. But when you have all these buyers coming in because the company put out good news and there are not that many sellers, the price is going to be pushed up because whoever is willing to pay the highest will get it. And that is the other cycle of the market, the price going back up. And you could see the curve. You could see that the price went down when the company offered more shares, adding more to the amount of volume of shares in the market. People didn't see it as a positive thing. They sold, causing the price to decline. Then the price is on the bottom edge, right? If you think about it, visualize it. Then the good news comes in, and the buyers come in and they start bringing the price back up. That is the basic cycle of the financial market for a specific instrument, right? In this example, the company. Well, that happens over and over and over. And not specifically about a company making an offer of adding more shares to the pool, but it could be anything. It could be external factors to the company causing buyers and sellers to make unique decisions for themselves. In another lesson, we're going to cover how retail traders are influenced by investors' past behavior. And the example I provided will remind you that the past conduct of these investors when they sold the stock and then when they brought the price back up in the example does not predict the future price of the stock in the example. All that is just past information. Thank you for watching. If you haven't subscribed, please do so. If you like the content in the video, smash that like. On to the next video.